Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Michael Zuber. Michael is a former Silicon Valley accounting professional turned full-time real estate investor and the author of One Rental at a Time, where he promises if you can get to 4 doors, it will change your life. Additionally, he hosts the everyday daily YouTube channel, One Rental at a Time, where he dispenses tons of useful investor knowledge by discussing current events and their effect on the real estate market. And he also has a panel of real estate experts he interviews regularly for additional knowledge. And he's also got an online course, and he's got a challenge to get to 500 deals, of which I have participated in here, and grateful member of his audience there. And I can't encourage you enough to check him out. And in just a minute, we're going to speak with Michael about rentals and rental market. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Michael. Welcome to CRE PN Radio.
Oh, thank you for the opportunity, and congratulations on being one of the 500. That is awesome.
I was going to ask you, I hadn't heard recently, and I catch you at various times. Where
Sure.
are you, your audience on the count?
So we are about 3.5 months in, actually exactly 3.5 months in, and we're sitting at about 157. So we are on a pace to get there. I would clearly like to blow it out because I actually bought 1,500 cards, hoping that we accelerate into this. But right now, 3.5 months in, we're feeling okay. I think we're going to get there.
And the end of the goal is it the year end? Is it 12/31 or
no? I had this. I had the crazy idea the last day of May, so I didn't see any reason to wait. So June 1st of 2021 through May 31st of 2022. So kind of summer to summer.
Gotcha. Well, I'm always encouraged when I'm watching and checking out your information there on your platform, and love to see that there's an active investor, group listening and participating. So that's great.
It's been fun. Yeah. On the daily financial show, I always start, right? If people send me, like you would have gotten a shout out in the morning, right? Hey, Darren got one. So yeah, this morning we had 2 people get a shout out. So 2 more cards went out today.
Oh, sweet. Hey, before we get started here, if you could take just a second and share with listeners a little bit about your background.
Mm-hmm. Yeah. So Michael Zuber, as you mentioned, lived in the Silicon Valley my entire life. My real estate journey starts after losing $150,000 in the stock market. It starts right around my 30th birthday. Read Rich Dad, Poor Dad, that purple book that meant so much to many of the Gen Xers out there. And I didn't know. I wasn't introduced to rentals. Nobody in my family owned them, didn't know it was a thing. But I realized I wasn't Warren Buffett. I wasn't going to conquer the stock market. I needed something that I could work off hours, right? I could do it as, today it's called a side hustle. It wasn't called that 20 years ago. But yeah, I built my portfolio off hours. I worked 70, 80, 90 hours a week. I did 1 million miles on airplanes. So I had a crazy day life. I was raised, was married, had raising a daughter. So my life was busy like a lot of your listeners. And, lo and behold, lose all that money in the stock market, have $40,000 to my name. And we end up buying a property 2.5 hours away in Fresno, California in 2002. And we haven't looked back. So that's kind of the start. It ends with financial freedom at 45, 4 or 5 years ago. And, kind of a fun ride those 15 years.
Oh, that's awesome. Well, I love the fact that you're not only, talking the talk, but you're walking the walk kind of thing. And, And
Mhm.
I cannot stress this enough for anybody that is not familiar with you or your platform. The amount of information you put out, and I'd love to hear about how you do it. I'm assuming
Mhm.
you read a lot,
Yeah.
because you're constantly providing daily practical,
Mhm.
boots on the ground information that, and how in just kind of your approach is how's it going to affect an investor,
Yeah.
kind of thing. Um, I'd love to hear how you go through that.
Yeah. So the beauty of all of this is the only thing I've added to my life is I talk to the camera, because what I've been doing for the last 20 or 25 years is I'm a morning person. My wife is evening person. So for the last 20 some odd years, I'm up at 6 o'clock, between 5:30 and 6 o'clock, no alarm clock. So what I have done for the last 20 years or so is I read, I drink my coffee, I kind of decompress, right? I get ready for the day, but I read for an hour to 90 minutes every day for 20 years, Saturday, Sunday included. It's just like, it's my habit. Now what I do is I do that and I take notes. That's kind of one different, right? I take notes and I talk about them, but everything comes from the eye of a investor. And more specifically, I have an econ degree from a Santa Clara University and MBA as well. So I have that hindsight. And you said I was an accounting professional, right? So I'm a numbers individual. So I bring that background. I've been in the market for 20 some odd years, and I just talk about what's going on. And then lo and behold, I've had 8 multimillionaires that over time have joined me for weekly conversations, right? Jonathan is on Thursdays, Anna's on Wednesdays, Omar and all these other folks. So the beauty of my channel is it's just not me talking to a camera. I have 8 other multimillionaires that talk to me throughout the week. So really, each of those conversations is 3 videos. So yeah, I put out 5 videos a day, a daily financial show, likely 3 experts, and then I'm still doing this business, right? I'll be closing on another duplex this week or maybe Monday. But yeah, YouTube is just for a way for me to give back, so I don't get a day job, right? When I retired, I almost went back and got a job because I'm still up at 6 a.m. I just didn't have anything to do. I'm like, God, what am I doing? I'm 45. I'm type A. I got to feel like I'm contributing. So I'm convincing myself that this is how I give back by contributing content every day.
Well, I count myself as one of your connoisseurs, and I appreciate all the info you put out there. So,
Thank you.
uh, hopefully you keep doing that. Um, so I wanted to start with kind of a conversation about um, the what is it do you think that most people miss when trying to, if their goal is to invest in a property? I know one of the things that one of the teachings that I've heard you comment on, and I subscribe to is identifying a market,
Mm-hmm.
get to know a market, be an expert in a market.
Mm-hmm.
And I was kind of curious from your experience and your talking with others and just kind of assessing the situation. If you could kind of you know look at it and tell me what do you think that most of the investors or potential investors miss?
Yeah.
Uh,
I think the biggest one is, I believe, my opinion is, becoming a good or great real estate investor is a skill. And what I mean by that means nobody is born with it. It means everybody has to go through it. And what do I mean by that? Well, the best analogy I have is a golf swing. You see, I didn't pick up a golf club until I was almost 20 years old. And I played baseball and, naturally athletic. But I got to tell you, the first time I put a golf club in my hand, it was the most unnatural thing I've ever done. It just feels weird. I pulled muscles I didn't know I had. It was just, I bounced the club on the ground. It was just a horrible experience. But what happens with a golf swing is you go on the driving range and you get a bucket of balls and then another bucket of balls and another bucket of balls. Your swing just naturally gets better, right? The body figures it out. And then as you're doing that, and then if you go get coaching, it takes that raw, feeling, it even makes it better. So now let's equate this to real estate investing. I believe all real estate investors need to simplify in the beginning. So what I preach, what I talk about is, I get it. You're excited. I get it. You're a shooting star. Maybe you've got capital and it's just burning a hole in your pocket. Stop. Go look at a market, get a buy box. And what do I mean by a buy box? I mean, you need to get super specific. And I'll use the buy box that I had in 2002, right? So For example, I live in the Silicon Valley, which is ridiculously expensive. I wasted a year trying to find cash flow here. It didn't work even in 2002. So ultimately we find Fresno, California. Fresno is a market I've never lived in. I drove through it once when I was 13 on the way to Yosemite, know nothing about it. It's 1 million people roughly. Now it was probably 600 to 700,000 then. Too big for me to figure out. Okay, fine. So I do some basic research. I find an area that's middle of the road. It's 93703. It's a part of town they call the Mayfair District. The Mayfair District, rough and tough's 100,000 homes, still too big, right? I go, okay, great. So ultimately what I have to do is I have to go Mayfair District, 93703, single family homes. So not duplexes, not quads, not apartments, not condos, between 1,200 and 1,500 square feet. The reason I did that is I wanted a list that was manageable that I could scan every single day. I looked at that same set for 3 years and only bought in the Mayfair District for that. Because why? Because I ultimately learned that buy box better than 99% of agents, brokers, anyone. So what happens after another bucket of balls and another bucket of balls, right? Another day, you start to go, ooh, that one's different. Oh, that one's listed, this way and that way. It's probably like this. And ultimately, once you know average, you can do good or great deals. So I believe the trick is to get simple, get tight, get daily with it, and then ultimately find average. And once you know average, you can do good or great deals. I think every investor needs to do good or great deals. And if you don't do the work to learn average, you're gambling. And I don't like to gamble.
No, that's pretty clear and actionable. I love the analogy, or not the analogy, but what you did with kind of just narrowing it down to where you could really, study and become an expert in one thing. Single family homes from 12 to 1,500 square feet or whatever that was
in that area. Yeah.
I mean that's pretty smart on your part, as opposed to oh wow, look, in Denver you can buy for, oh wow, over here
Yeah, don't do that. Don't try to compare Denver with Austin, with Miami, with Cleveland. You'll go nowhere.
Yeah, exactly. I think that for anybody that's excited about real estate and wanting to get into real estate, it's real easy to get kind of that all over, and you'll talk to somebody, they go, oh, don't buy there, you can't cash flow there, and they'll send you over to here, and they'll give you their reasons, and then but it really is just kind of like just get rid of the noise, pick your spot, and then become that expert in it.
Because this is what happens, right? Because once you, again, trying to relate it to the golf swing, right? So when you're on the driving range and you finally figure it out after 90 days of going every day, i.e. you're looking at a market every day. Once you do that, you're like, I know what an average deal in the Mayfair districts for 12 to 1,500 square feet. Once you've proven that, now you can take that skill and go to any market you ever wanted to go to. It's just like a golf swing. Once you're done with the driving range, you can take that golf swing to a pitch and putt, to Pebble Beach, to all these other fancy courses. It doesn't matter. The course doesn't matter. Just like the other city wasn't matter. You don't pick a market first. You got to build your skill set first, in my opinion.
Oh, that's awesome. Let me ask you about investors' expectations versus reality with respects to like cash flow. I think one of the upsides you would have with being familiar with a market like Fresno is you would know, again, when a deal's a good deal, ripe, and it's going to cash flow well versus it's not. Do you have any kind of a sense of or do you, I guess, what are your thoughts on that? Because cash flow in some of your larger markets, like you mentioned in your backyard, was not attainable.
Yeah.
Versus like an appreciation play where there's no cash flow, but there's, if you sell, then you've got some equity.
Yeah. For me, I learned very early on. And again, this is probably because I suffered that $150,000 stock market loss. I was never going to play the appreciation game. The house that I live in, still in the Bay Area, is appreciated wonderfully. And someday it'll cash out and be a great day. But I never wanted to bet for that. I wanted to produce income that I could easily pay my bills with. That's why we sacrificed for 15 years, is I wanted to enjoy the rest of my life knowing that my monthly bills are paid for. And you can't do that with appreciation. I've lived through the last crash. I knew people that were worth 10 million bucks that went bankrupt inside of 18 months. That's what happens when you bet on appreciation. The market can go against you. If you're betting on cash flow and the market goes against you, who cares, right? You don't usually spend your net worth. And oh, by the way, the last crash, rents went up, not down. So I just simply, I never calculate, look at appreciation ever, ever, ever. The only time I do it is when I have to fill out a financial statement for a loan. I don't even look at net worth. You asked me my net worth, I wouldn't even answer. It's like, it's an irrelevant number. It's made up.
Right. Not unless you sell everything today. Right.
Yeah. Not doing that.
Yeah. Right. Right. No, I appreciate that, and I've learned myself kind of the slow way. I think when I first started investing, I thought, well, just bleeds a little bit each month, and was always happy to be at the front of the line and get my taxes done because there was enough write-off that I was getting something back, kind of thing. But having had a property that cash flowed, I was like, wow, this thing really works. There's actually money coming in, and then
that's awesome.
Well, and just the ability to have a second stream of income, an unexpected stream of income, to where you can actually, create a savings and actually then go invest more. I mean, it's just such a different mindset as opposed to, living payment to payment, or just kind of spending everything you've got, which I think is, I don't think it's unique to a particular demographic or an income earner. I think that the more people earn, the more they spend.
Life creep. Yep.
Yeah. Boat payments, car payments, vacation home payments, vacation payments, whatever it is. If you have more and you spend more than you earn, and you're upside down there. But couldn't agree more with the cash flow thing there. Yeah. I wanted to get a little bit of your input on what your thoughts are, and just for perspective. You and I, we talked one time before here about almost a year and a half ago, right after when COVID started. I had you on, and just kind of some COVID perspective. But I think, where we were talking then was more of like a front end of unexpected, what can happen. My question to you today is more of, now, with all of the measures that have been put in place, the eviction moratoriums, the cash that's flooded the system, the forgiveness of the rent, or I shouldn't say the forgiveness. There's supposed to be money in there that's supposed to make its way from the government to the agency to the landlord. But all of that, just the COVID cash and the COVID mindset based on renters and buyers. If you could kind of summarize what you think how that will play out in the next year or 2, 3 years in the real estate market. Yeah.
So let's kind of do two things, because I remember that conversation from about 14, 15 months ago. I think there's two things that I will admit were unexpected surprises. The first one is rent collection, even ultimately the government making up, the $45 billion that they've approved in 2 different tranches. Rent collection proved to be far better than expected, right? When we got the notice that it was shutting down and evictions were put in place, I remember having a Sunday conversation with my property manager going, how bad can this be? And we were actually penciling in 50%, right? If 50% happened and we got a lot of stuff, where are we, right? And how long would our reserves last and all that? So long story short, we never collected less than 97.5. I think the average was 98%, 98.1. It's about 0.5% worse than normal. So not fun, but not catastrophic, right? And then ultimately, when the government finally makes up for what has been short, we'll probably be even. So rent collection, first off, proved to be better than expected. Second, home appreciation. Was that a shocker? Man, people didn't list their homes, which I called expected, right? It's this thing that was talked about was like, don't come in my house, you got cooties. So that part I got right. But man, this whole millennials leaving condos and vertical living, leaving the cities of New York and San Francisco, people going to the suburbs, that there are a lot of niche markets that got 5-10 years of people moving to there in a year. And building doesn't work that way. demand moves faster than supply. In some of these markets, I mean, Boise, Idaho is the extreme example, right? It
Right.
just, the demand, it was probably like 15 or 20 years of demand showed up in a summer. And guess what happens to prices when that happens? It just explodes. And yeah, so those are the first two things that shocked me. Now, as we look forward, I think there's a couple of things that we can count on. First and foremost, inflation is real. And I actually think it's underreported, specifically when you look at housing cost, which is something I look at all the time. The housing numbers that just came out in CPI yesterday, today's Wednesday, so yesterday, and PPI the following week, they're really not reporting any rent equivalent increases. It's like 1.7%, where everything I'm seeing, it's double digits. This is houses and apartments. So at some point, that's going to come home to roost. And I think rents continue to go up because we've been, we're 5 million units underproduced for the last 12 years, right? Housing development hasn't been keeping up with housing formation. And as we exit this, I think we're going to see housing formation increase again, because there's a lot of people that have retreated. They lived with mom and dad, they've had roommates or whatnot. And once we start getting out of this, which we've got to be right on the cusp of getting out of this, I think housing formations is going to explode again, right? So demand will again outpace supply. So I think housing is going to be pretty strong going forward. I don't want to see 20% on top of 20%. That's not healthy. I invested in Fresno, California for 20 years, and we had 2 years in a row where we were the top market, year after year, I think 03, 04, 04, 05. And that becomes a bubble, right? It just,
Right.
it's a problem. I think we should plateau, but man, if money stays cheap, and there's some things going on now where money can stay cheap, meaning the 30-year mortgage, it's a great time to buy. I mean, I did a 50-year chart the other day, going back on wages, interest rates, payments, all of these things. And there's some surprising things in there your audience may not realize. First one is in the 1970s, which is actually a period that I think we are emulating right now. It was a decade of 8% inflation. That was the average. But what is interesting is interest rates went up 300 basis points. It was the last decade we had where rates were higher at the end than the beginning. The subsequent 40 years, rates have been going down for 40 years. I believe that reverses this decade. But why is that important? Well, first and foremost, you would think if rates go up 300 basis points, that housing would get rocked. It simply didn't. Housing went up 106% in the decade. How did it do that? Because the other thing, wages went up 87%. I believe there are two things happening in inflation that are not being reported. Rent, I've already hit. Wages is the next one. I believe we are going to see an era of wage inflation, which of course, as it happens, feels good in the moment. But guess what? Prices go up across the board, right? Chipotle raised the wages of their employees, and they had to raise the cost of my burrito bowl by 4%. It's got to come from somewhere. So I think wages are going to go up a lot in the next couple of years, but then, rents will go up and then assets will go up. It's if you're bouncing around the bottom of this, it's not going to feel good because you're going to feel it the most. Inflation is the biggest tax that nobody talks about.
No doubt. I mean, you put all that money into the system, and it's naturally. I mean, the pie doesn't necessarily expand. 2x. It's pretty much the same pie. It's just the cost of the piece of pie is keeps going up there.
That's basically the definition of inflation: is more money chasing a fixed set of goods. You just pay more. It's kind of what it is.
And so. I mean, the borrowing rates, I mean, it's funny because I feel like, there was a mindset and earlier in some of my investing, there was a matter of, buy when the rates were up, refi when they're down, and things would really cash flow then. And, but now, I mean, I'm just kind of curious, the Fed and just the supply of money and just, as everything seems like it's got some traction, do you feel like things are still somewhat fragile in that if interest rates did go up, the wheels could fall off? Or
well, it's funny. Again, I read every day, right? So again, we're talking on the 15th of September as an example. So just today I read about the largest property developer in China $300 billion not making payments. It kind of feels like a Lehman moment in China. And if there's a lot of counterparty risk, which China's economy is very opaque, I know very little about it, but that's a lot. The property market in China could be a problem. Why this goes into your question is, what happens if the largest second economy in the world has their version of our Great Recession? That just means more dollars from around the world, including euros and Australian dollars and all the. Are they going to flood to the USD, the US dollar?
Yep, seek safety.
They're going to, when the world is scared, they come to the dollar. That's not going to change probably in my lifetime. And I think the world is a lot more fragile, to your question, than people think. I naturally think that the rates should be higher. But when I look at the overall world economy, I think the world economy is far shakier than people want to admit. And we could have do we have a recession next year? Oh, man, what could happen there? So I think rates stay low, and then I think rates stay low longer than they naturally should, which hurts savers. I'm talking about the people who've been crushed savers. I mean, I got some money in the bank and earn 0.05%. I mean, no wonder people are buying real estate. That's why Wall Street is buying rentals, because you get 6 or 8% on your money.
Right. No, you're getting 0.05. You're winning there. That's I get 0.02. So.
Yay.
But no, I just have a hard time seeing a way where the rates can increase dramatically. I mean, I could see like a quarter of a point here, a quarter of a point there, but I think the bigger concern, and I'm not an economist, but I guess the idea has always been, if you had a little bit of cushion there and you needed to kind of goose the economy, you could lower the rates. Well, if you're already down at zero kind of thing, that you haven't given yourself much room for if you need to do something, at least not with just rates. I mean, I know there's other levers they can pull and do that. But
well, they certainly have, right? They started what the new thing, at least from my memory, that they did is they started buying junk bonds this time, right? It wasn't only lowering rates, but they stepped in to be the buyer of last resort during the real thick of this thing. They still have those levers, right? They could start buying ETFs and other. I mean, they can get really squirrely, but by then, I mean, I'm not sure what that's telling us, but it doesn't feel good if the Fed has to come in and be that buyer.
Yeah. So, and we're talked a little bit about the demand for housing, and you mentioned kind of the formation of housing changing. If presumably we have inflation, which would be associated with like wage increase and price increase, interest rates stay, let's just say they stay relatively the same. Sure. Again, you're still a payment buyer. I mean, that's what buyers are, is a payment. So if they're making X and the payment is less than 30% of that for, I mean, kind of the market for housing, does that change, or do you think that's
no? I think real estate is much like cars. I think it is really, for most people, a payment decision. And again, that 50-year chart I built, the payments, at least in 2020, they were the lowest on record. They were roughly 16% of your monthly gross income, which is called a front-end ratio by mortgage brokers. Now, in 2021, July, which was the last numbers I looked at, it went up a little bit. It went up to 20%. But when you look back historically, 43 of the 50 years, the payment structure was 29% or less. We are still very affordable today. That said, there is another wrinkle in all of this, and that is the down payment is becoming a problem, right? In my assumption, I assume 10%, which is about right if you look at the entire market. But when you look at first-time buyers, they're more like 6%. But down payment is going to become the problem, right? Because down payment is getting up there, right? The average home's now 366 or 369, and you take 10% of that, it's 34 grand. And then you look at the average person, they've got $18,000 saving it. We are, if you can get the down payment, stuff is more affordable than it's been most years. But the down payment is becoming a problem, and it's higher than the trend line. And the trend line is about 33%. Today, it's about 36 or 37%. So it's the down payment's actually becoming a bigger problem, which is probably why we hear the administration talking about first-time buyer programs and this, that, and the other thing. So we're always a payment buyer because that's what you get approved for, but you got to have a down payment. So that's becoming a bigger problem.
Now, it's interesting you bring that up. I know, like even in commercial with just the cap rate compression and just the demand for deals, how the market may be X, but the debt service cover ratios are still at the same percentages, and I've seen some lenders require a greater down payment to make the deal work. Again, if you're doing commercial and you're doing syndication, or you're bringing capital from somewhere else or other people or joint venture or whatever. But it does seem to make like just a slightly skinnier deal. But again, if the demand stays strong, and housing clearly is nationwide, just the demand for housing is there. Then if you add in all of the COVID supply chain, question marks that have come up, I don't see that changing anytime soon. I think it's just a matter of I see the demand to be strong.
Again, the beauty about studying economics and watching it for so long is you realize that there's some truth. And with housing, housing demand is instant, nearly instant, where supply takes years, right? Permitting and zoning and building and all of that. But demand, right? We come out of this crisis and we have the next version of a baby boom, where couples get together and want to move in instantly and get married and start popping out babies. Oh man, demand's not going away.
No, that's for sure. Hey, let me ask you quick on you're a purveyor of all the news and what's topical. What's your sense on the 1031 exchanges and taxes with regards to real estate?
I don't think they're going away. I think that was a thing put out there as kind of a trial balloon. It's and having studied this for a long time, it's been floated for years. Basically, what people now realize is if you got rid of 1031 exchange, which they absolutely could, but what would happen is the commercial market and the market of the largest production of housing affordability, it would slow down to a trickle. So if they got rid of it, it would stop people moving up and thus creating more housing, which is exactly what they want and need. I think they've now come to realize that would be so detrimental to housing, but in commercial housing, that they've got to get rid of it. It's a foolish idea.
Right. Any crystal ball on taxes, capital gains, and that?
I think what's going to happen is, again, if I was going to bet on it, they scared us. They're playing classic negotiation games. They want to scare you at taking it to ordinary income at 39.6, which for me in California, when I add in California, it would take me to 53%. Guess what? I don't sell anything at a 53% tax. They know that. They're not complete idiots. They're only partially idiots. So what I expect them to do is they'll probably come in. My guess is somewhere under 30%, 25. I'd guess 25, 30% is where they'll come in, because they got to raise taxes somehow. You can't spend $3.5 trillion and not raise taxes, but they can't take it to 39. Because again, what will happen? Well, I will not sell any assets. I will simply refi them and take a loan, which is not taxable. So I think they realize that that's a non-starter too. I hope.
Wait a minute, are you saying trickle down doesn't work here?
Yeah, I am saying that. Yes.
All right.
It's a sexy message. It just doesn't work.
No. I hear you. No, and it is kind of an interesting thing. I mean, if you understand policy enough, that basically it's a way to encourage behavior. I mean, it's the whole thing. And if you look at the tax code, it rewards investors. It rewards people that create LLCs or create businesses that go out and invest. And that's kind of the underlying current of our economy is investment. Absolutely. You have to have investment. If basically I had everything I had and you had everything you had, and neither one of us exchanged with each other, you don't have an economy. I'm basically it's that exchange of goods and services that makes it all work. And that is what has to happen for it all. I mean, we are all connected together in that.
Totally agree.
So you got to have that keep going. It is funny though when you think about how all the taxes and this whole notion about taxing corporations and stuff. And I I keep reminding myself of the lesson I learned that you can tax that, but reality is all that gets paid out to the shareholders. And I mean, you're talking about a very small piece with respects to, and again, I'm not an economist, but as opposed to at the individual level where the money gets paid out to,
Mhm.
kind of thing. And I think sometimes it's a sexy, notion, but I don't know what it actually accomplishes when you have ways that corporations can,
Yeah.
hide and
I
manipulate things.
yeah. So I think there's a big talk track about raising the tax rate for corporations, 21 to 26 or 27 or whatever they're going to call it. But unless they change the rules, simply moving the index is marginally effective, because again, the big thing is Amazon, right? Everybody talks about Amazon making gazillions of dollars and paying zero taxes. Well, the tax code says if they make investments in warehouses and do this, that, and the other thing, they could take bonus depreciation and wipe it all out, and it's still zero. So unless you're going to go change the rules, i.e. the tax code, it doesn't matter what the rate is. You can make it 90% and Amazon still pays zero, right? So
Yeah, no, and it's again, it's kind of a news bite, or it's, kind of the, attention getter kind of thing,
Mhm.
but it's in reality, it's noise.
Mhm.
Um, Michael, if we could, I'd like to shift gears here for a
Sure.
second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. The first is we look to see if we can avoid the risk.
Mhm.
The second is we look to see if we can minimize the risk. And if we can neither avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is.
Mhm.
And as a broker, I like to ask my guests if they can take a look at their own situation. It could be
Mhm.
their clients, investors, the marketplace, tenants, however you would like to frame the question.
Mhm.
Um, and again, for clarity, I'm not necessarily looking for an insurance related answer.
Mhm.
But if you're willing, I'd like to ask you, Michael Zuber, what is the biggest risk?
So the biggest risk, and again, I ask myself this all the time, right? Because I look at it, I go, what are my biggest risks? And if I can survive the downside, right, through all those things, I think about it all the time. So in my portfolio, my biggest risk that I've been working on all year is variable interest rate risk. I have commercial loans. I own apartment buildings, and those loans reset 3, 5, 7, 10 years, depending on what you have. And over the last year, I have feared that I could see at point of refi where rates, I had a rate at 3.5. I was like, what happens if this is 7, 7.5? Right. So what I have been doing actively over the last year or so is taking all of my loans and looking for ways to get 30-year money. One thing you can do, because there's now, for the first time really in the last couple of years, there are these vendors called non-QM lenders, non-QM lenders. And I work with a lender who has taken all of my apartment risk and allowed me to get 30-year money at 3.99%. So it's not a Fannie Freddie loan; it's a 3.9 non-QM lender. So I've been actively working to get all of my apartment buildings, and I'm even paying prepay penalties on one of my loans, because I'm deathly afraid of interest rates shooting up, and if that happens, of course, apartment buildings, if rates go to 7, cap rates got to go to what, 9, 10, and then the valuation calls and they're going to say, hey, you're now in technical default and you got to cut a big check. That freaked me out for a while. So I've been working very hard to take all of my adjustable rate mortgages on apartment buildings and go get 30-year money, even though my payment goes up slightly now, I'm okay with that. So that was the biggest one for me, because I looked out years ahead and go, wow. Because again, I've been through the last crash. What caused the last residential crash? It's all those adjustable rate mortgages that popped up and their payments reset. I looked at that going, oh my God, if that happens to my apartment buildings and then the cap rate goes up and the value is cut in half, where do I go? So that was the big one for me. So I'm working on my last one right now.
Yeah, that's never a fun, letter to open that congratulations, your loan is resetting and the interest rate is now,
Yeah.
being nice if it's going down, but not when it's going up there.
Yeah.
So,
Yeah, and
Gotcha.
again, that the biggest thing for the commercial stuff, right, is because if that happens and the cap rate goes, and then you have a revaluation, then you're in technical default, and they're like, okay, you want to cut a check for 150 grand?
Yeah. No, not
Yeah,
really.
no. So
So
that was mine.
no, I appreciate that. Interest rate is definitely, I mean, as an investor, the whole market, I mean, is pricing and everything's sensitive to that. And
Yeah.
if that changes, your whole model changes. And if your cash flow is based on that, uh, definitely want to pay attention to that. So I appreciate that. Michael, where can the listeners go if they would like to learn more or connect with you?
You can go to your Google search bar and type in one rental at a time. You should see a YouTube channel, a book, a website, Instagram. Hopefully easy to find at this point.
I check it out daily and I encourage everybody else to as well. Michael, I can't say thanks enough for taking the time to talk today. I've thoroughly enjoyed it. I'm a big fan and look forward to doing it again soon.
Anytime. Thanks, buddy.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.